Hi everyone, today I want to talk about some of the most common mistakes I see in transfer pricing benchmarking analysis for intercompany loans. Tax authorities are paying closer and closer attention to these transactions, so it's important to know what to watch out for to avoid trouble. First, let's remember, intragroup loans, like any other controlled transactions, should be at arm's length. The most common method for verifying that is the comparable uncontrolled price method, usually using external databases. So, what are the key mistakes I see? Mistake number 1, missing or incorrect credit rating. One of the very first things tax authorities look at is whether the borrower's credit rating has been calculated correctly. And this is critical because your credit rating has a direct impact on interest rates. Better creditworthiness means lower interest rates on the market. If the rating is miscalculated or if it's missing altogether, the benchmark is on shaky ground and authorities can challenge the arm's length nature of the pricing. Mistake number 2, poor selection of comparable transactions. It's not enough to just find loans given to companies in the same industry. Authorities will challenge comparables even if they involve businesses that face very different risks or are in very different stages of development. For example, comparing a startup to a major business will likely not fly. You need to look beyond the industry and make sure you're taking into account risk profile, size, market, and the borrower's actual ability to service the loan. Another issue I often see is a focus only on the interest rate, while ignoring other terms and conditions, such as whether the loan is actually being repaid or whether additional fees or covenants apply. All of that matters when assessing comparability. Mistake number 3, not keeping the analysis up to date. According to the OECD transfer pricing guidelines, benchmarking studies should generally be updated every 3 years, and financial data should be refreshed annually. If there is some major change in market condition, say interest rates shift significantly, you may need to update sooner. And if the new benchmark differs materially from your original one, you should also adjust your intercompany loan terms to stay arm's length. So, what's the takeaway? Tax authorities today are much more sophisticated in how they review transfer pricing analysis. They will challenge not only the outcome, but also the methodology and the assumptions behind it. To stay on the safe side, make sure you have a robust and properly documented credit rating. Carefully select comparables that really reflect the borrower's risk profile and circumstances. Review all loan terms, not just the headline interest rate. Keep your analysis current. Update benchmarks regularly and adjust terms when needed. And above all, document, document, document. Solid evidence is your best defense in an audit. And remember, the goal is to set your loan conditions at arm's length ex ante before the transaction is entered into. That way, you are protected if the authorities come knocking later. Thanks for watching. See you in the next video.